There exists a ghost in the machine of modern capitalism. It is an invisible, silent force that dictates the actions of the vast majority of corporations, investment funds, and ambitious individuals. It is not a conspiracy, nor is it a conscious decision. It is a cognitive virus, an evolutionary artifact of the human mind that has scaled to the level of global markets, and it is the single greatest engine for the production of mediocrity the world has ever known. This virus has a name. It is the institutional imperative. Understanding this imperative, deconstructing it, and engineering a cognitive immune system to protect yourself from it is the most crucial and most overlooked step in the journey from mere ambition to elite-level wealth and success. The world believes Warren Buffett is a master stock picker. This is a profound and costly misunderstanding. Warren Buffett is a master of applied psychology. His true arena is not the stock market. It is the flawed, predictable, and exploitable architecture of the human brain. And his greatest opponent, the one he has structured his entire life and the colossal empire of Berkshire Hathaway to defeat, is this very ghost in the machine. He recognized, decades before anyone else, that the greatest returns are not found by being smarter than the herd, but by having the discipline and the mental framework to simply refuse to join it. The institutional imperative, in its simplest form, is the tendency of organizations to mindlessly imitate the behavior of their peers, regardless of whether that behavior is rational or value-enhancing. It is the gravitational pull towards the institutional average. It is the voice that whispers in the ear of every chief executive, every fund manager, every department head, everyone else is doing it. You should too. It is born from a cocktail of potent psychological biases, the comforting warmth of social proof, the paralyzing fear of being left behind, the career risk of being a contrarian who fails versus the safety of being a conformist who fails, and the simple, mindless expansion of bureaucracy. As Buffett himself defined it, it is the force that causes the lemming-like tendency of corporate management to imitate the behavior of its peers, and it ensures that any business craving of the leader, however foolish, will be quickly supported by detailed rate of return and strategic studies prepared by his troops. This is not an academic concept. It is a destructive force with a body count measured in trillions of dollars of shareholder value. It was the institutional imperative that fueled the disastrous conglomerate craze of the 1960s, where companies rushed to diversify into businesses they had no right to be in, simply because it was the fashionable thing to do. It was the institutional imperative that drove the world's largest banks to load their balance sheets with incomprehensible mortgage-backed securities before 2008, not because each one independently concluded it was a brilliant idea, but because their competitors were doing it and the profits, for a time, were immense. The fear of missing out outweighed the fear of a systemic collapse. It is the institutional imperative that causes technology companies with vastly different business models to all pour billions into the same trendy acquisitions or strategic initiatives, leading to overpayment, redundant effort, and the eventual quiet write-down of those very assets a few years later. The virus thrives on a simple, deadly logic. It is often better for one's career to fail conventionally than to succeed unconventionally. If you follow the herd and the herd runs off a cliff, you can blame the cliff. You can point to your peers and say, "We all made the same mistake." The environment was unpredictable, but if you stand alone, on a different path, and you stumble, your failure is yours and yours alone. It is seen not as a probabilistic outcome, but as a personal flaw. This asymmetry of risk creates an almost irresistible pressure to conform. And so the machine grinds on, producing a sea of sameness, of diversification, of Me Too strategies, and of action for action's sake. But here is the critical insight, the one upon which the entire Buffettian cognitive framework is built. Where there is a systemic, predictable, and irrational bias, there is an extraordinary opportunity. The institutional imperative creates immense distortions in the market. It causes entire industries to become overvalued. It causes sound and profitable businesses to be overlooked simply because they are not fashionable. It creates panic selling and euphoric buying on a mass scale. The virus, in its relentless pursuit of conformity, creates the very anomalies that a rational, independent mind can exploit for massive gain. This is not a video about a single investing tip. This is a complete deconstruction of the cognitive immune system that Warren Buffett has spent over 70 years perfecting. We will not just define the virus. We will put it under the microscope. We will dissect its psychological roots, its corporate manifestations, and the subtle ways it infects your own decision-making process. Then, we will reverse engineer the antidote. We will build, piece by piece, the Buffettian framework for cognitive independence. We will deconstruct the layers of his defense, the fortress of first principles thinking that makes him immune to dogma, the circle of competence that acts as a strategic quarantine zone against infection, the temperamental shield that weaponizes emotional control against the market's manias and panics, and the owner's mindset that fundamentally severs his allegiance to the herd. This is the blueprint for rewiring your brain. It is the operator's manual for thinking in a way that 99.9% of your competitors cannot. To build a fortune like Buffett's, you must first learn to see the world as he does, not as a chaotic and unpredictable arena, but as a laboratory of human folly, where the greatest rewards are reserved for those who have the courage and the framework to simply stand apart. Let us begin by dissecting the anatomy of this infection, by understanding the very wiring of our own minds that makes us so susceptible to the siren song of the herd. To defeat the enemy, you must first know the enemy, and in this battle, the enemy is us. Part 1. Anatomy of the infection. The psychology of institutional folly. The institutional imperative does not arise from a vacuum. It is not a modern invention or a phenomenon exclusive to the world of finance. It is the macroscopic manifestation of microscopic flaws in our own cognitive hardware. We are, by our very nature, social creatures, and the wiring that allowed our ancestors to survive on the savannah is the very same wiring that leads to catastrophic decisions in the boardroom. To build an immunity, we must first understand the disease at its genetic level. The first and most powerful psychological root of the imperative is the principle of social proof. In a world of uncertainty, the human brain uses a simple, energy-saving shortcut. If a lot of other people are doing something, it's probably the right thing to do. This is a deeply embedded survival instinct. For our ancestors, seeing a group of people suddenly run in one direction was a powerful signal that a predator was approaching. The individuals who stopped to analyze the situation to gather more data were likely the ones who were eaten. The ones who ran first and asked questions later were the ones who passed on their genes. This copy-first instinct is burned into our neural circuitry. In the modern world, this translates to a reliance on the actions of others as a proxy for our own research and critical thinking. When a particular stock starts to rise rapidly, the principle of social proof kicks in. The rising price is seen as evidence that others, presumably more informed than we are, have discovered something positive. The fear of being left out, a close cousin of social proof, ignites. The desire to join the winning crowd becomes overwhelming. The same is true in corporate strategy. When a leading company in a sector announces a major strategic shift, a move into a new market, a large-scale acquisition, or the adoption of a new technology, it sends a powerful signal to its competitors. The executives at those competing firms are immediately put on the defensive. Their boards will ask, "Why aren't we doing that? Do they know something we don't?" The pressure to respond, to announce a similar strategy, becomes immense. It is often easier and safer from a career perspective to launch a flawed, copycat initiative than to explain to shareholders why you are standing still while your rivals are making bold moves. The tragedy is that the initial move by the leading company may itself have been a mistake. But the power of social proof creates a cascading effect, a feedback loop, where imitation validates the original action, encouraging even more imitation, until an entire industry is chasing the same foolish idea. This is the dot-com bubble in a nutshell. A few companies with flimsy business models achieved astronomical valuations. This created powerful social proof. Venture capitalists, fearing they would miss the new economy, poured money into any company with a .com in its name. Investment banks, seeing their competitors reap huge fees from IPOs, rush to bring even weaker companies to market. And individual investors, watching their neighbors get rich overnight, abandoned all pretense of valuation and piled in. The herd was running, and no one wanted to be the one left standing still to be devoured by the lion of missed opportunity. The second psychological pillar of the institutional imperative is what is known as commitment and consistency bias. Humans have an innate desire to be consistent with their past decisions and public statements. Once we have taken a stand or made a choice, we feel a powerful internal and external pressure to behave consistently with that commitment. In the corporate world, this bias is magnified. When a company embarks on a large project or acquisition, it is a public commitment. The CEO announces it to the press, it's detailed in the annual report, and analysts build it into their financial models. Now imagine that 6 months into the project, evidence begins to mount that the initial assumptions were wrong. The market has shifted, the synergies aren't materializing, the costs are spiraling out of control. The rational course of action would be to cut losses, to admit the mistake, and to reallocate the capital to a more promising venture. But the commitment and consistency bias makes this incredibly difficult. To reverse course would be to admit a public failure. The CEO's reputation would be damaged. The team that championed the project would lose face. So instead of cutting their losses, the institution often does the opposite. It doubles down. It throws good money after bad, hoping that a larger investment will somehow salvage the failing project. This is the escalation of commitment. The initial smaller mistake, driven perhaps by social proof, becomes a catastrophic multi-billion-dollar failure because of the psychological inability to admit error. Buffett has often said, the most important thing to do if you find yourself in a hole is to stop digging. The institutional imperative, supercharged by commitment bias, hands the CEO a bigger shovel and tells him to dig faster. The third root of the virus is the authority bias. We are hardwired to defer to the opinions of experts and authority figures. This is another cognitive shortcut that is often useful. We trust our doctor's medical advice and our mechanic's assessment of our car. The problem arises when this deference becomes blind obedience, or when the experts are themselves caught in the same psychological traps as everyone else. In the world of finance and business, the authorities are the major consulting firms, the elite investment banks, and the star CEOs. When these institutions and individuals endorse a particular trend or strategy, it is given a stamp of legitimacy that is difficult to question. A strategic plan developed by a prestigious consulting firm, complete with detailed charts and impressive-sounding jargon, is less likely to be critically examined by a board of directors, even if its underlying assumptions are flawed. The authority of the consulting firm's brand acts as a substitute for independent thought. Similarly, when a celebrated CEO, lauded on the covers of business magazines, makes a particular move, it is seen as an act of genius that should be emulated. The authority bias leads other, less confident CEOs to copy the star's actions, believing they are following a proven winner. They are not copying the rigorous thought process that may, or may not, have led to the star's decision. They are simply copying the decision itself. This creates a dangerous situation where a single person's potential mistake can be amplified across an entire industry, as competitors rush to imitate the perceived best practice of the leader. These three biases, social proof, commitment and consistency, and authority, form a toxic psychological cocktail that provides the fertile ground in which the institutional imperative can grow. But the virus has another, more structural component that relates to the way large organizations are managed and the way their leaders are incentivized. This is the agency problem. In a large publicly traded company, the managers, the agents, are supposed to act in the best interests of the owners, the shareholders. However, their personal interests are often very different. The primary interest of most CEOs is not necessarily the long-term, per-share intrinsic value of the business. Their interests are often tied to the size of the empire they command, their personal compensation, and their public reputation. This disconnect leads to a number of behaviors that fuel the institutional imperative. Firstly, there is the bias towards action. A CEO who simply sits back and allocates capital prudently but infrequently may be doing the absolute best thing for shareholders, but it doesn't look very impressive. It doesn't generate exciting headlines or win awards. The CEO who is constantly engaged in transformative deals, who is always reshaping the portfolio, is seen as dynamic and visionary, even if those actions are destroying value. The pressure from the board, from analysts, and from the business press is always to do something. This action bias means that even if the best course of action is to do nothing, the institutional pressure will be to make a suboptimal move rather than no move at all. Secondly, growth in size is often prioritized over growth in per-share value. A CEO's compensation, power, and prestige are often directly correlated with the size of the company they run. This creates a powerful incentive to grow the company at all costs, even if that growth comes at a low or negative rate of return. The easiest way to grow quickly is through acquisitions. And so we see waves of merger and acquisition activity, where the primary driver is not a clear strategic logic or a compelling valuation, but simply the institutional desire to get bigger. The acquiring CEO benefits from a larger empire, and the investment bankers who advise on the deal benefit from enormous fees. The only loser, often, is the shareholder of the acquiring company, who ends up owning a piece of a larger but less profitable business. Buffett has called this the growth at any price mindset, and he sees it as a direct consequence of the agency problem. The managers are playing with other people's money, and the incentive structure encourages them to expand the empire rather than enrich the owners. Finally, there is the problem of mindless risk-taking. This sounds counterintuitive. One would think that a bureaucratic organization would be risk-averse. And it is, but only when it comes to personal, career-level risk. As we discussed earlier, it is very risky for a manager's career to be a contrarian. But it is not risky at all to take a massive business risk, as long as all of your competitors are taking the same risk. This is the paradox of institutional risk management. The focus is on managing the risk of looking different, not on managing the actual financial risk of the business. This is why the entire banking industry was able to take on a level of leverage and exposure to the housing market that was, in retrospect, completely insane. For any single banker to have stood up and said, "This is madness, we need to pull back," would have been career suicide. They would have been accused of being timid, of not understanding the new paradigms of risk distribution, of costing the bank billions in lost profits. It was far safer, from a personal career standpoint, to continue dancing while the music was playing, even if you could hear the foundations of the building beginning to crack. The combination of these powerful psychological biases and the structural incentive problems within large organizations creates the perfect storm. It creates a system that is almost perfectly designed to produce irrational, imitative, and value-destroying behavior on a mass scale. This is the environment in which we all must operate. It is the water we all swim in. And it is why the task of achieving cognitive independence is so difficult and so incredibly valuable. Buffett's genius was to recognize the existence of this storm not as a threat, but as the single greatest opportunity of his lifetime. He understood that you don't have to be a genius to get rich, you just have to be sane in a world that is periodically and predictably insane. The first step to building his cognitive fortress was to accept this reality, to see the world not as it should be, but as it is. A stage on which the same psychological dramas play out over and over again, just with different actors and different props. The next step, the one we will now deconstruct, was to build the specific mental tools and operational habits required to ensure that he would never be swept away by the storm. He would build an ark, a cognitive ark, designed to sail through the floods of institutional folly, picking up the priceless assets that the drowning masses were abandoning in their panic. Part 2. The Buffettian Immune System, Engineering Cognitive Independence. To survive and thrive in an environment saturated with the virus of the institutional imperative, a standard, off-the-shelf mental operating system is not enough. It requires a custom-built, multi-layered cognitive immune system designed specifically to identify, neutralize, and even profit from the predictable irrationality of the herd. Warren Buffett's entire life, from his choice of where to live to how he spends his day, has been a masterclass in the construction of such a system. It is not a single trick or a simple rule. It is a deeply integrated architecture of mindset, habits, and analytical frameworks. We will now deconstruct this immune system into its 5 primary layers. Layer 1. The fortress of first principles thinking, the antidote to dogma. The institutional imperative thrives on dogma. It operates on received wisdom, on best practices, on the way things have always been done. It relies on people accepting assumptions without questioning them. The first and most fundamental layer of Buffett's cognitive defense is a ruthless commitment to first principles thinking. This is the practice of breaking down a complex problem or a situation into its most basic fundamental truths and reasoning up from there. It is the opposite of reasoning by analogy, which is what most of the world does. Reasoning by analogy means looking at what others are doing and saying, this situation is like that one, so we should do what they did. This is the very engine of the institutional imperative. It is a cognitive shortcut, a form of imitation. First principles thinking is much harder. It requires you to discard all inherited dogma and build your own understanding from the ground up. Consider the insurance industry, the bedrock of Berkshire Hathaway. When Buffett first entered the insurance business, the industry was governed by a set of sacred dogmas. One of these was that you could not expect to make a profit on the underwriting side of the business, the process of pricing and assuming risk. The conventional wisdom was that an insurance company should aim for a, quote, combined ratio of around 100. A combined ratio measures the total costs and losses of the insurer as a percentage of the premiums it collects. A ratio of 100 means the company is breaking even on its underwriting. The profit, so the dogma went, was to be made by investing the float, the premiums collected from policyholders that have not yet been paid out in claims. The industry as a whole was competing to write as much business as possible, often at unprofitable prices, just to get their hands on more float to invest. This was a classic example of the institutional imperative at work. The entire industry was chasing the same strategy, leading to intense price competition and poor underwriting results. Buffett, applying first principles thinking, rejected this dogma entirely. He reasoned from the ground up. What is the fundamental purpose of an insurance contract? It is to accept a risk from someone else in exchange for a price, the premium. The fundamental truth of this transaction is that if you consistently price the risk for less than it costs you in eventual claims and expenses, you are engaged in a value-destroying activity. The float you receive is not free if you have to pay more than $1 in underwriting losses to obtain each dollar of float. He concluded that the primary goal of an insurance operation must be to achieve an underwriting profit. The float should be seen as a happy byproduct of a profitable core business, not the sole reason for its existence. This seems obvious in retrospect, but at the time it was a radical departure from industry norms. By reasoning from first principles, Buffett was able to see the foolishness of the herd's strategy. He instructed his insurance managers to reject any business where they could not get a rational price, even if it meant their premium volume would shrink dramatically. While his competitors were chasing growth at any cost, Buffett was focused on profitability. This discipline allowed Berkshire's insurance operations to consistently generate underwriting profits, meaning they were actually being paid to hold the float. This is a massive competitive advantage, and it was created not by some complex financial engineering, but by the simple act of rejecting a flawed industry dogma and returning to the fundamental economic reality of the business. How does one cultivate this ability? Buffett's method is relentless learning and independent verification. He does not outsource his thinking. He reads voraciously, but he reads to understand the fundamental reality of a business, not to absorb the opinions of others. He reads annual reports, trade journals, and historical accounts. He is trying to build a mental model of how a business or an industry actually works, from the ground up. When he analyzes a company, he is not asking, what is the consensus opinion on this stock? He is asking fundamental questions. What is the durable competitive advantage of this business? How does it generate cash? What is the long-term outlook for its industry? What is a rational price to pay for its future stream of earnings? He builds his own conviction based on his own analysis of the fundamental facts. This creates a powerful immunity to the narratives and fashions that sweep through the market. When the herd is euphoric about a new economy stock with no earnings, his first principles analysis of what constitutes a business, an enterprise that generates cash for its owners, allows him to see it for what it is. When the herd is panicking about a temporary problem at a great company, his first principles understanding of that company's long-term competitive advantage allows him to see the panic as an opportunity. The fortress of first principles is the bedrock of cognitive independence. It is the deep, foundational work required to have a point of view that is truly your own. Without it, all other defenses will eventually crumble under the immense social pressure to conform. Layer 2, the circle of competence, the strategic quarantine zone. Even with a commitment to first principle thinking, the world is an overwhelmingly complex place. It is impossible to be an expert in everything. The institutional imperative gains a powerful foothold in the areas where our knowledge is weakest. When we are operating outside of our own deep understanding, we are most susceptible to relying on the opinions and actions of others. We fall back on cognitive shortcuts like social proof and authority bias. Recognizing this vulnerability, Buffett built his second layer of cognitive defense, a ruthless adherence to what he calls the circle of competence. This concept is often misunderstood as a simple suggestion to invest in what you know. Its true power, as a defense against the institutional imperative, is far more profound. The circle of competence is not just an offensive tool for finding good investments, it is a defensive protocol for avoiding cognitive infection. It is a strategic quarantine zone. Buffett's rule is simple. He defines the perimeter of his circle, which includes the businesses and industries he can understand with a high degree of certainty. Everything else, no matter how exciting or popular, is relegated to a too-hard pile. He makes no attempt to be a universal expert. He is, in his own words, a specialist in the easy cases. During the dot-com boom of the late 1990s, Buffett was famously criticized for not investing in technology stocks. He was called a dinosaur, a man who had lost his touch and didn't understand the new paradigm. His refusal to participate in the frenzy looked, to the outside world, like a massive mistake. But from inside his cognitive framework, it was the only rational course of action. Technology companies at that time were outside his circle of competence. He couldn't, with any degree of certainty, predict what the competitive landscape would look like in 10 or 20 years. He couldn't reliably project their future cash flows. He didn't have a deep first principles understanding of their business models. And because he was operating outside his circle, he knew he would be susceptible to the psychological contagions of the bubble. He would have no internal compass, no bedrock of independent analysis to anchor him. His decisions would inevitably be influenced by the euphoric narrative, the soaring stock prices, and the actions of the crowd. He would become just another member of the herd. So he simply refused to play the game. By defining the boundaries of his competence and staying strictly within them, he quarantined himself from the virus of the tech bubble. He was willing to accept the short-term pain of looking foolish and missing out on paper gains in order to avoid the long-term certainty of catastrophic losses when the bubble inevitably burst. The power of this discipline cannot be overstated. The institutional imperative constantly tempts us to stray outside our circle. It presents us with exciting opportunities in fields we don't understand. The fear of missing out, FOMO, is a powerful lure. The stories of others getting rich in cryptocurrency, in biotechnology, in some new disruptive technology create immense pressure to participate. The circle of competence is the mental rule that gives you the permission to say no. It is the courage to say, I don't know, and therefore, I do nothing. This is not a sign of weakness. It is the ultimate sign of intellectual honesty and cognitive discipline. It is the recognition that the greatest risk is not missing out on the next big thing, but being drawn into a game where you don't know the rules, and where the crowd's emotions are your only guide. The size of your circle is not what's important. As Buffett says, what's important is knowing the perimeter. A small, well-defined circle is infinitely more valuable than a large, fuzzy one. Inside that circle, your decisions can be based on your own first principles analysis. You are the expert. You are immune to the opinions of the crowd because your knowledge is deeper than theirs. Outside that circle, you are a potential victim. You are relying on hope, on narrative, on the wisdom of others, the very fuel of the institutional imperative. This quarantine strategy is a core component of Buffett's immune system. It keeps him on the territory where he has a massive analytical advantage and prevents him from wandering into the territory where he would be just another follower, susceptible to the madness of the crowd. Layer 3. The temperamental shield, weaponizing emotional control. The institutional imperative is not a purely intellectual phenomenon. It is powered by the raw, primal emotions of fear and greed. The desire to conform is fueled by the fear of being left behind, and the greed that comes from seeing others make easy money. A purely analytical defense, therefore, is not sufficient. You can have a perfect first principles understanding of a business and a well-defined circle of competence. But if you are unable to control your own emotions, you will still be swept away by the tide of market sentiment. This is why the third layer of Buffett's immune system is the temperamental shield. He has stated that the most important quality for an investor is temperament, not intellect. This is the ability to detach one's own emotional state from the emotional state of the market. It is the ability to be greedy when others are fearful, and fearful when others are greedy. This is easy to say and incredibly difficult to do. It requires a deliberately engineered set of habits and a specific mindset. Buffett's entire lifestyle can be seen as a system designed to build and maintain this temperamental shield. First, there is his famous location. By living and working in Omaha, Nebraska, far from the frenetic, emotionally charged environment of Wall Street, he creates a physical and psychological distance from the herd. He is not bombarded by the constant chatter, the rumors, the minute-by-minute market swings that fuel emotional decision-making. He is not having lunch with other fund managers who are all talking about the same hot stocks. He has deliberately created an environment of informational and emotional isolation. This allows him to process information calmly and rationally, without the distorting filter of crowd emotion. Second, there is his schedule. Buffett's diary is famously empty. He spends the vast majority of his day, up to 80%, simply reading and thinking. He is not in back-to-back meetings. He is not constantly reacting to emails or news alerts. He has engineered his life to allow for long, uninterrupted periods of deep thought. This is crucial for maintaining emotional control. Emotional, reactive decisions, the kind that the institutional imperative encourages, are a product of System 1 thinking, our fast, intuitive, and emotional brain. Rational, analytical decisions are a product of System 2 thinking, our slow, deliberate, and logical brain. By dedicating his time to quiet contemplation, Buffett ensures that his decisions are made by System 2. He is giving himself the time and space to think through problems from first principles, to consult his internal framework, rather than having a knee-jerk reaction to external stimuli. Third, there is his use of the Mr. Market allegory. This mental model, learned from his mentor Benjamin Graham, is a powerful tool for emotional detachment. He imagines the market not as an omniscient judge of value, but as a manic-depressive business partner. Some days, Mr. Market is euphoric and offers to buy your shares from you at ridiculously high prices. On other days, he is despondent and offers to sell you his shares at absurdly low prices. Mr. Market is the personification of the institutional imperative's emotional swings. The key to this mental model is that you are free to ignore him. You are not forced to trade with him. You can take advantage of his offers when they serve your interests. selling to him when he's euphoric, buying from him when he's despondent. But you never let his mood influence your own assessment of the underlying value of the business. This allegory creates a psychological buffer. It allows Buffett to view the market's volatility not as a source of risk or fear, but as a source of opportunity. He is not a part of the emotional crowd. He is a rational observer, waiting to transact with an irrational partner. This temperamental shield is not a passive trait. It is an active, cultivated discipline. It is the result of a lifetime of deliberate practice. It is the understanding that your own emotional state is the biggest threat to your success. The market will constantly try to infect you with its fear and greed. The institutional imperative will constantly whisper that you should be feeling what everyone else is feeling. The temperamental shield is the conscious decision to build a firewall around your own mind, to ensure that your decisions are a product of reason, not of emotional contagion. Layer 4. The owner's mindset, the ultimate allegiance shift. One of the most subtle and powerful ways the institutional imperative takes hold is by shaping our very identity. If you see yourself as a stock trader or a market participant, your allegiance is to the market. Your frame of reference is the ticker tape. Your sense of success or failure is tied to the daily fluctuations of stock prices and your performance relative to your peers. Your focus is external. This identity makes you incredibly vulnerable to the herd. The fourth layer of Buffett's defense is a radical shift in identity, the owner's mindset. When Buffett buys a stock, he is not buying a piece of paper or a digital blip on a screen. In his mind, he is buying a fractional ownership of an actual business. He is becoming a silent partner in that enterprise. This is not just a semantic difference. It is a fundamental shift in psychological allegiance. His allegiance is no longer to the market, but to the long-term economic reality of the business he now partially owns. This shift changes everything. As a business owner, you are not concerned with the daily mood swings of Mr. Market. You are concerned with the fundamental performance of the business, its earnings power, its competitive position, its return on capital. You think in terms of years and decades, not days and weeks. The stock price is relevant only at 2 points: when you buy and when you sell. In between, it is largely a distraction. By adopting the owner's mindset, Buffett makes himself immune to the vast majority of market noise. The chatter of analysts, the short-term economic forecasts, the quarterly earnings misses or beats. All of this becomes secondary to the fundamental question: is this a good business, and did I buy it at a sensible price? This mindset also provides the fortitude to act as a contrarian. When the market panics and sells off a great business because of some temporary headwind, the market participant panics along with it. Their frame of reference, the stock price, is collapsing. But the business owner sees a different reality. They see an opportunity to increase their ownership stake in a wonderful enterprise at a discounted price. The lower the price, the more attractive the opportunity. This is why Buffett is able to be greedy when others are fearful. His allegiance is not to the fearful crowd, but to the logic of business ownership. The owner's mindset is also the antidote to the action bias that plagues so many institutions. A business owner does not feel the need to constantly trade in and out of their own company. Their default position is to hold on, to let the business compound its value over time. Activity is the exception, not the rule. This patience and low turnover approach is the polar opposite of the hyperactive, performance-chasing behavior that is characteristic of the institutional imperative. This shift in identity is perhaps the most profound part of Buffett's cognitive immune system. It is a complete reframing of the game. He is not playing the market's game of predicting short-term price movements. He is playing the long-term game of owning profitable, well-managed businesses. By choosing to play a different game, he makes himself immune to the rules, emotions, and irrationalities of the game everyone else is playing. He has, in effect, achieved a psychological secession from the market's herd. Layer 5, the power of inaction, and the 20-slot punch card. The final layer of the immune system is behavioral. It is the set of forcing functions that translate the mindset into disciplined action, or more often, disciplined inaction. The institutional imperative creates a powerful bias for activity. Managers feel they must always be doing something, making acquisitions, launching initiatives, reorganizing departments to justify their positions. Buffett's defense against this is a profound appreciation for the power of inaction. He understands that in investing, and in many aspects of business, activity is often the enemy of good results. Every decision you make carries the risk of error, and the more decisions you make, the more likely you are to make a significant one. The key, therefore, is not to make more decisions, but to make a few, very high-quality decisions. To enforce this discipline, he uses a powerful mental model, the 20-slot punch card. He asks students to imagine that they have a punch card with only 20 punches on it for their entire lifetime. Every time they make an investment decision, they have to use one of their punches. With such a limited number of decisions, you would become incredibly careful. You would not swing at every pitch. You would wait for the perfect opportunity, the fat pitch, right in your sweet spot. You would do a massive amount of research, and you would have to have an extremely high degree of conviction before you were willing to use one of your precious punches. This mental model is a direct assault on the institutional imperative's demand for constant activity. It forces you to raise your standards dramatically. It shifts the default from yes to no. It makes opportunity cost visceral. Before making a new investment, you would have to ask, is this opportunity so good that it is worth using one of the only 20 slots I have for my entire life? This framework makes it much easier to resist the temptation of mediocre Me Too ideas. It provides a powerful justification for the most difficult thing in the world of business: sitting still and doing nothing. For months or even years, the best course of action may be to simply let your existing, high-quality businesses do their work. The 20-slot punch card provides the psychological armor to do just that, even when the rest of the world is frantically busy. These 5 layers, the fortress of first principles, the circle of competence, the temperamental shield, the owner's mindset, and the power of inaction, do not operate in isolation. They are a deeply interconnected, mutually reinforcing system. Your first principles thinking allows you to define your circle of competence. Staying within your circle makes it easier to maintain your temperamental shield, because your decisions are based on knowledge, not emotion. Your owner's mindset provides the long-term perspective necessary to deploy the power of inaction. Together they form a near impenetrable defense against the virus of institutional folly. They are the architecture of a truly independent mind. But knowing the architecture is not enough. The final step is to begin the hard work of construction. It is to move from theory to practice, to begin the process of rewiring your own brain to operate on this superior system. Part 3. The Inoculation Protocol. Building your own cognitive immunity. We have deconstructed the virus of the institutional imperative and reverse-engineered the 5-layer cognitive immune system that Warren Buffett uses to protect himself. Now we arrive at the most critical stage: implementation. A blueprint is useless unless you begin to build. The following is a practical, actionable protocol, an inoculation protocol, designed to help you begin the process of building these defenses into your own life and decision-making process. This is not a quick fix. It is the beginning of a lifelong discipline. Step 1. The Information Diet Audit. Starve the virus. The institutional imperative is transmitted through information. It feeds on the noise of the market, the daily commentary, the analyst upgrades and downgrades, the expert predictions, and the sensationalist headlines. The first step in building your immunity is to ruthlessly curate your information diet. You must starve the virus of the low-quality, emotionally charged information it thrives on. For the next 30 days, commit to a radical information diet. Eliminate all consumption of daily financial news. This means no CNBC, no Bloomberg TV, no checking stock quotes multiple times a day. Unfollow the market commentators and FinTwit personalities on social media. The goal is to create a space of cognitive silence. This will be uncomfortable at first. You will feel out of the loop. You will experience the fear of missing out. This is a withdrawal symptom. It is the virus fighting back. Push through it. Replace that low-quality, high-frequency information with high-quality, low-frequency information. Your diet should consist of a few core food groups. 1. Annual reports. Go directly to the primary source. Read the annual reports of companies you are interested in, especially the shareholder letters. Read the reports of their competitors. This is where the fundamental reality of a business is described. 2. Trade journals. To understand an industry from first principles, read what the people inside that industry read. This will give you a much deeper and more nuanced understanding than any analyst report. 3. Biographies and history. Study the long-term history of businesses and industries. Read the biographies of great business leaders. History provides the context to see that the new paradigms are often just old follies in new clothes. 4. Books on foundational concepts. Read books on psychology, decision-making, and science. Build your toolkit of mental models. This information diet does two things. First, it insulates you from the emotional contagions of the market. Second, it provides you with the raw material to do your own first principles thinking. You are shifting from being a consumer of opinions to a builder of understanding. This is the first and most critical step in declaring your cognitive independence. Step 2. The Antidote Journal. Codify your thinking. Your own mind is a flawed instrument. It is subject to hindsight bias, believing you knew it all along after an outcome is known, and a host of other cognitive errors. To build discipline, you must make your thinking visible and hold yourself accountable. The tool for this is an antidote journal. This is not a diary of your feelings. It is a rigorous log of your most important decisions, written asterisk before the outcome is known. For any significant business or investment decision you are considering, you must write down the following. 1. The thesis. In 1 or 2 paragraphs, what is the core reason you are considering this decision? What is your hypothesis? 2. The circle of competence check. On a scale of 1 to 10, how well do I understand this situation and its key variables? Am I operating in the core of my circle or at the fuzzy perimeter? Be brutally honest. 3. The first principles analysis. What are the fundamental, undisputed facts of this situation? What are the key variables that will determine success or failure over the long term? 4. The institutional imperative check. What is the herd doing in this situation? What is the consensus view? If my view is different, what specific knowledge or insight do I have that the herd does not? If my view is the same, am I sure I am not just succumbing to social proof? 5. The pre-mortem. Imagine it is 1 year from now, and this decision has been a complete disaster. Write a story of how it failed. What went wrong? This exercise forces you to confront the potential risks before you are emotionally committed. This journaling process is a powerful forcing function. It forces you to slow down and engage your System 2, analytical brain. It creates a record of your reasoning that you can go back and review, allowing you to learn from both your successes and your failures. It is the practice of building your own internal intellectual framework rather than borrowing one from the crowd. Step 3. The solitude protocol. Design your environment. Your environment has a profound impact on your thinking. The modern corporate environment, with its open-plan offices, constant meetings, and pressure for instant communication, is almost perfectly designed to foster herd behavior and shallow, reactive thinking. You must deliberately engineer your environment to support cognitive independence. Schedule solitude blocks in your calendar. These are non-negotiable 60 to 90-minute blocks of time where you are unreachable. No phone, no email, no meetings. This is your time for deep thought, for reading, for working on your antidote journal. Protect this time as if it were the most important meeting of your day, because it is. Practice asynchronous communication. Resist the institutional pressure to respond to every email instantly. Batch your communications into specific times of the day. This frees you from a state of constant reactivity and allows you to control your own focus. Find your own Omaha. This may not be a physical location, but a psychological one. It could be a specific place you go to think, a time of day when you are isolated, or a specific set of habits that separate you from the noise. The goal is to create a sanctuary where your own thoughts can be heard above the roar of the crowd. Consciously designing your environment for solitude and deep work is a radical act in today's world. It is also an absolute prerequisite for developing the kind of independent thought that is necessary to defeat the institutional imperative. This protocol, the information diet, the antidote journal, and the solitude protocol, is not a set of tips. It is a training regimen for a cognitive athlete. It is the hard, daily work of rewiring your brain to resist the powerful gravitational pull of the herd. It is the process of building, brick by brick, your own cognitive fortress. Conclusion: the final frontier. We have traveled deep into the cognitive territory of Warren Buffett. We have dissected the institutional imperative, the pervasive virus of mediocrity, and we have laid bare the blueprint of the sophisticated immune system he engineered to combat it. We have seen that his true genius lies not in his ability to predict the future, but in his profound understanding of human nature and his discipline in constructing a system to protect himself from its follies. The fortress of first principles, the quarantine of the circle of competence, the shield of temperament, the allegiance shift of the owner's mindset, and the discipline of inaction. These are not just investment strategies. They are a prescription for a life of rational, independent thought. They are the tools to escape the great trap of modern ambition, the endless, exhausting race to be slightly better than the average, a race that is rigged from the start by the very structure of our minds and our institutions. The path we have outlined is not easy. It requires intellectual honesty, emotional discipline, and a willingness to look foolish in the short term. It requires you to stand apart from the crowd, to bear the discomfort of solitude, and to trust your own analysis, even when the entire world is telling you that you are wrong. But the reward for this struggle is the ultimate form of freedom, cognitive independence. It is the ability to see the world with clear eyes, to make decisions based on reality rather than narrative, and to allocate your capital and your time with a sovereign rationality. It is the only path to truly extraordinary results. Yet, in our deconstruction of this immense external battle against the herd, we have alluded to an even more fundamental struggle. We've talked about building a fortress, an immune system, a shield, but what is the ultimate source of its power? What is the internal bedrock upon which this entire anti-imitation framework is built? Resisting the external pressure of the institutional imperative is a monumental task, but it is a task that becomes impossible if your internal guidance system is compromised. The virus of the herd can only truly infect you if your own sense of self-worth is dependent on the approval of that herd. To truly become immune, you must first build an unshakable internal compass. The ultimate defense against the noise of the outside world is a clear and unwavering signal from within. This brings us to the single greatest psychological distinction between the ultra-wealthy and the ambitious masses. It's the critical difference between judging yourself by the world's standards or by your own. It is the foundational conflict between living by an outer scorecard and living by an inner scorecard. To master the external game we've discussed today, you must first win this internal one. The blueprint for engineering that internal compass, for rewiring your brain to operate on its own inviolable metrics, making you truly and permanently immune to the opinions of others, is the subject of the video appearing on your screen right now. Click on it to begin the final and most important step in building your cognitive fortress.